And welcome back, Market Rebels. So a couple of other terms you're going to hear when you start getting into options is exercise versus assign. And these are terms that will come up all the time, but they also cause a lot of confusion for new traders. So what exactly is it when we talk about exercise versus assign? Well, to understand, we have to back up a little bit and talk about some of the most basic elements of options, and that is rights versus obligations. This is really the whole foundation of the options market. And it turns out that option buyers have rights. Whenever you buy an option, whether it's a call or a put, you have a right to do something. And you are paying money for the right to either buy or sell shares. In the case of a call, you have the right to buy the stock, and in the case of a put option, you have the right to sell the shares. But the point is that you are paying money for some type of right. Now, on the other hand, option sellers have obligations. Both traders cannot have rights, both cannot have obligations. One party has the right, the other party has an obligation. Now, you might think, hey, obligations aren't all that good. Why would anybody want an obligation? Well, you're going to receive money for accepting an obligation. So in some cases, you're probably going to find out there's a risk that you're already accepting. And somebody might be willing to pay you some money for accepting that risk. And that might be a perfect time for lots of different strategies where you can sell an option, and in exchange, you're going to have some type of obligation. So what are these rights and obligations? Well, they're pretty easy to figure out if you just create a little table like this. So most traders find it fairly easy to understand the rights of a call buyer and a put buyer. So let's start there. If you buy a call, you have the right to buy shares. And if you buy a put, you have the right to sell shares. Now, once you figure these rights out, the sell side is just on the opposite side of the transaction. So they have the opposite sets of these words right here. So if you sell a call option, you have the obligation to sell the shares. Notice that the opposite of right is obligation, and the opposite of buy is sell. So again, if you have trouble remembering these rights and obligations, start with the buy side, and then just flip it for the sell side. Well, what if you are the put seller? Well, again, start by understanding the rights. The put buyer has the right to sell, so the put seller, being on the opposite side, must have the opposite set of transactions here. The put seller has the obligation to buy shares. And as before, notice the opposite of right is obligation, and the opposite of sell is buy. So these are the basic rights and obligations that you either are paying for or that you are accepting in exchange for cash. So now that we have these basic terms out of the way, what does it mean to exercise? Well, let's start with a call option. Let's say that you buy a call option, and in doing so, understand that the buyer has the right to buy 100 shares of the underlying stock for the strike price. So whatever that strike price or that exercise price is that you purchased, that's the price at which you are locked in. So for instance, let's say that you buy the January $50 call and you pay $3, which means $300 in total, because each contract controls 100 shares of stock. So in doing so, you have the right to buy shares for this $50 strike right here, which would be $5,000 in total. Again, that's because it's $50 per share times 100 shares per contract. So it's a right, it is not an obligation. But in order to do that, if you choose to use this call option and buy the shares, you must exercise the call. That's what it means to exercise. You can think of it as just invoking your right to do something, whatever that right happens to be. So in the case of a call, you're saying, yes, I would like to invoke my right to buy 100 shares of stock for the strike price. Now, you can do this at any time for any reason. If it's an American style option, which most of your equity options are in the stock market, some of your indexes aren't. But for the most part, you can exercise the call at any time for any reason, even if it's out of the money. Sometimes traders think that you can't do that, but you absolutely could. Not saying it's necessarily a good idea to do it, but you could. However, if the option is at least 1 cent in the money at expiration, it'll be automatically exercised unless you instruct the broker otherwise. So in this example, if the stock closes at $50.01, 50.01 or higher, it's going to get exercised automatically. Now again, if it is an in-the-money option, you could call the broker and say, I don't want to exercise it. It's a right. You are never forced to exercise it. So to be clear, the only exception would be is if you let that option go in the money by at least a penny and you do nothing. You don't call the broker, you don't close the option, it just goes into expiration at least 1 cent in the money. Yes, it's going to get automatically exercised. And on Monday morning, you're going to be the proud owner of 100 shares of stock. So here's what it might look like graphically. If you are long the $50 call, long just means that you purchased it, and you exercise it. And it's very easy to do. You're just going to, some platforms allow you to just click on a little button. Some might require that you pick up the phone and call the broker, but it is not any type of a long drawn out process. It's just, yes, I wish to exercise, and that's it. And if you do that, you're going to pay the strike price in this example, $50 per share or $5,000 total. That'll automatically get debited from your account, and you will automatically receive 100 shares of the underlying stock. But again, the only time that this happens is if you exercise the option or if you allow it to go through automatic exercise. Okay, so that's how it works for call options. What about a put option? Let's say that you buy a put option. In this case, the buyer has the right to sell 100 shares for the strike price. Remember, the call buyer has the right to buy, the put buyer has the right to sell. So if you instead bought the January $50 put for $3, again, that would be $300 total to buy this put. It is giving you the right to sell shares for that strike price of $50 or $5,000 total, no matter how low that stock price might go. It could go to zero. The company could actually file for bankruptcy. And all you'd have to do is to use this put option and say, I want to sell my shares for $50. But to do that, you must exercise the put. So again, go into your broker's platform, check off a little box, I want to exercise it. They might require that you pick up the phone, but it's a really easy process. No paperwork to fill out, just say, yes, I wish to exercise the put, and it's done. Now, the same rules apply for the puts, that if an option is at least 1 cent in the money at expiration, it'll be automatically exercised unless you instruct the broker otherwise. So in the case of a put, it's working backwards. So in this example, if you have the $50 put, if the stock is, let's say, $49.99 or less, then it's at least 1 cent in the money. And if you didn't call and tell the broker that I don't want to exercise this put, it will get automatically exercised. What if the stock is above 50? It's trading for 50.01 or higher, and for some reason you wanted to use it and sell your shares. Yes, but you have to exercise it. So that's really what it means, is that you wish to use either this call or this put, in the case of a call to buy the shares or in the case of a put to sell the shares. That's what it means to exercise your option. So as before, let's look at it graphically. If you are long the $50 put, again, that just means that you bought it, and you exercise it, you are going to sell 100 shares of that underlying stock. It'll be automatically taken out of your account, and you will automatically receive $5,000 in this example, or whatever that strike is. So in this example, it's a $50 put. So because each contract controls 100 shares, that would be $5,000 cash you would receive, and it's just that simple to exercise a call or a put. So now that you understand what it means to exercise, what does it mean if you get assigned? Well, an assignment is really just the trader on the other side of a transaction. It's the traders who sold the option. You cannot get assigned on a long option or one that you purchased. You could only get assigned on a short option. So short just means that you've sold it. So let's start with a call. Let's say that you sell a call option as part of some strategy. Well, in doing so, remember that the seller has the obligation to sell 100 shares for the strike price. So if you sell the January $50 call for $3, or again $300, you collect $300 up front, and in doing so, you have the potential obligation to sell 100 shares for the strike, or in this example, $50 per share or $5,000 total. However, you cannot command this like you could when you were the long option. You can't call the broker and say, I'd like to sell these shares now. Why? Because you are the short position. You've got an obligation. The only way that you would sell your shares in this example is if you receive an assignment notice. What causes an assignment notice? Well, it's because the long option decided to exercise. So you might receive an assignment notice from your broker just saying, hey, we're letting you know that you sold 100 shares of stock and you've received $5,000 cash. Okay, now let's take a look at the person who sells the put option. The seller has the obligation to buy 100 shares of stock for the strike price. So if you sell the January $50 put for $3, that's $300 cash up front in your hand, and in exchange, you have the potential obligation to buy 100 shares for $50 or whatever that strike price is. So in this example, with $50, it would be $5,000 total. But in order to do that, it would only happen if you receive an assignment notice. And again, an assignment notice is simply just an entry into your transactions in your brokerage platform. You'll just wake up one day and it's going to say, you were assigned on this call or this put. We're just letting you know that you have, in the case of a put, you have purchased 100 shares and we've debited your account for $5,000. There's nothing you need to do. It's just an automated process. But the idea is that the only time you get assigned is if you have a short position and if the long position exercises. So the main thing to understand is that when you sell an option, you cannot control that. You cannot say, I don't want to get assigned, or you can't say, I'd like to get assigned now. Why? Because you have an obligation. It's only the long position who can control the exercise, and if that happens, then you will get assigned. So here's the basic outline of it. Let's say that you are long a $50 call and you exercise. What happens? Well, you get automatically paired up with somebody who is short the $50 call. We have to have a long paired with a short. This is done from a random assignment, and so you're going to get paired up with somebody, and of course you will automatically pay $50 per share or $5,000. There's nothing you need to do other than saying, yes, I want to exercise this call. Your account's going to get debited for $5,000, and this person, whoever it may be, will receive $50 per share or $5,000. Where do they get the $50 from? From you. It is just being transferred from your account to theirs. Now, when this happens, that person who is short that call is going to receive an assignment notice, and they will automatically sell 100 shares from their account, and you are going to receive 100 shares. It's all automatic. There's no counterparty risk. It's not like the short position can say, you know what, I've decided to not sell these, or that you have to wait for their permission. It's all automatic, just by the long position saying, I wish to exercise. What about for a put? How would that work? Well, if you buy the $50 put and you exercise it, you will get automatically paired with somebody who is short the $50 put. And once again, this is by a random assignment. And when you do that, you are going to sell 100 shares of stock, and the person who is short that put will receive your 100 shares. They are going to get an assignment notice saying, hey, we're just letting you know you got assigned. We are debiting your account for $50 per share or $5,000, and it's getting transferred to your account. You will receive that strike price or $50 per share. So that's really all that it means between exercise and assigned. One of the reasons it causes confusion for a lot of new traders is that people will use these terms incorrectly, and they'll say, oh, I got exercised. And that's not really true. You got assigned. So if you hear the terms exercise and assigned, always understand that the word exercise applies to the long options only, and the term assigned applies only to the short options. And if you keep those points in mind, it'll make options trading a lot easier to understand.